Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, March 22nd, 2021, and I'm pre-recording this Trading Places Live for Tuesday, March 23rd. Futures currently are mixed. We're seeing a little bit of weakness on the NASDAQ, a little bit of strength on the Dow, which was opposite what we saw at the end of last week and then again on Monday. But I still think we're in this week where we're going to probably see a little bit of back and forth. I don't know that the market's ready to go anywhere just yet, especially the technology stocks. So I think we have a little bit of work still to do in the short term, but I do expect once we turn the page, start heading toward earnings season, I think that that's going to make a difference in how these technology shares trade, but we'll see. Before we get into the action today, we'll walk you through the agenda. We'll get into the daily market recap. Then talking technically, break it down. Going to look at an individual industry group today that's threatening a breakout. And I'll show you how I go through that. Then we'll go into earnings spotlight and wrap up the show with the three you must see. Before we get into any of that, though, let me take you over to earningsbeats.com. Love to have you join our community. If you're not already a member of our Earnings Beats Digest, it is a free newsletter that's published 3 times a week, Mondays, Wednesdays, and Fridays. All you need to do is sign up with your name, email address, hit that subscribe button, and you will be in line to receive those articles going forward. They'll be sent directly to your email. This is a completely free newsletter, no credit card required. You may unsubscribe at any time. It's simply a way for us to give you some insights into how we look at the market. I think you'll enjoy it. I think you'll find it educational with some trading opportunities along the way. Or if you'd like, we'd love to have you as a member at Earnings Beats. You can click on this green Join Today button. You'll be charged $7, but that $7 will be refunded to you within a week. So it's a 30-day free trial, or at least no-cost trial. And we'd love to have you come in and check out our services. All right, let's move on to the action from Monday. Dow Jones Industrial Average did come back to finish up 103 points. The S&P 500 was up 27. NASDAQ, best of all, up 162 points, up 1.23%. Its early strength, though, over the Dow and the S&P 500 was fading throughout the day. And like I said, after hours, we are seeing a little bit of relative weakness on the NASDAQ, so I'm not quite sure this rotation is quite done. March tends to be a month where we do see rotation. We do tend to see relative weakness in technology shares. So I wouldn't be ready to completely write that off yet. Mid caps finished down 15 points, small caps down 19. So we have seen a little bit of rotation out of the mid and small cap areas of late. You can see both about the last week to, I don't know, maybe week to 10 days. We've been seeing that pullback, a little bit of selling. Accumulation distribution, though, on all of the major indices, I think still looks pretty strong. Technology was the leader on Monday, gaining almost 2%. So that was nice to see. Still got work to do, though, at the moving averages. That 20 and 50-day moving average, you can see spanning 131 to 132, and we closed on the XLK at 131.87. So right in the middle there, I think the market's still showing some indecision. If you look closely off of this uptrend, you can see a left shoulder, neckline, head, right side of the neckline, right shoulder, down at about 128, 129. We might want to keep an eye on that level because if this pattern were to confirm and break out above 135, that would be another 11 points on top of 135, which would then send this target up to about 146 on the move. However, if we fail to hold the 128 level and make another run back, we could be in for another drop. I would be looking more for sideways consolidation before a return back to the 139 area to test that February high. But certainly in the short term, the best result here for technology would be a move back through that 135 level and break that neckline. Real estate up a little more than 1%, as was the consumer staples area. So staples, you can see, actually has made a breakout above recent highs. But both of these groups are defensive groups. So real estate and staples doing well today. But it wasn't, even though the market went up, NASDAQ led, technology did well. It wasn't like every area within the aggressive areas was moving higher. In fact, you can see financials, which has been one of the leaders, has pulled back again on Monday after losing ground on Friday and reversing on Thursday. So we were in breakout territory just a couple of days ago. Now the XLF pulling back, testing its rising 20-day moving average. I'm not sure that the 10-year Treasury yield goes too much lower. I think we're consolidating a little bit, but I really believe 10-year Treasury yield is going to go higher. And that's probably going to spook some people with regard to technology shares. I don't think it should, and I don't think it will eventually. But in the near term, that seems to be the narrative. And so that's what we live with for now. Once we turn our attention to earnings, though, I do think you're going to see a different area in technology. Banks, just like the financials I was just showing you, banks pulled back. 10-year Treasury yield was down today, so giving the banks a reason to pause here in the near term. 10-year Treasury yield, as far as economic reports go on Tuesday, we do expect February new home sales to come out at 10 a.m. Their expectation is for 875,000 units. If that's the case, it will be down from January, which was at 923,000. We did have a disappointing existing home sales report that came out on Monday, and it looks like we're expecting a pullback in February new home sales. So again, that'll be out 10 a.m. on Tuesday morning. Looking at the 10-year Treasury yield, though, you can see Friday and Monday both coming back down a little bit from the high that we saw back on Thursday. Maybe we go back and hit that 20-day. That would be about the furthest, I would think, in the short term that we would see the yields come down. But we're just on this march to the upside, and I think it makes a lot of sense. The Fed just, raised their forecast on growth, GDP. In December, they said 4.2%. At their meeting last week, they said 6.5%. So I think that we're getting a return to normalcy in the yield. Remember, the yield was 1.5% to 2% prior to the pandemic, and growth is actually going to be stronger than it was before the pandemic. So I wouldn't be surprised to see the 10-year Treasury yield in 2021 well into the twos. I would not rule out 2.5%, maybe even 3%. But again, if you're talking about a GDP of 6.5% or 7% or more, 3% interest rates, I still think that is nirvana for growth stocks. But we'll, keep playing it by ear and following it a day at a time. All right, let's move on to talking technically. First thing I want to do, when I talk about these pre-earnings run-ups, Tesla has been a poster child. And of course, history never guarantees us anything as far as future results go. But I just wanted to point out the last 5 earnings reports for Tesla. The black vertical dotted lines here, this marks the time when Tesla reported their quarterly results. And I want to just go back here and show you that in, January 29th, we reported. So on December 31st, this low right here, we were at $80.42 at the close. 4 weeks later, we reported earnings when Tesla was at $116.20. So there was a 45% pre-earnings move in the 4 weeks leading up to earnings. April 29th, we saw Tesla report. On April 2nd, right here, we had closed at $89.28. And just before earnings were reported, Tesla was at $160.10. That was a gain of $70 or about 78% move in just those 4 weeks before earnings. Let's go to June. So on June 25th, we closed at $187.43. July 22nd, when we reported, we were at $318.47. Tesla jumped 70% in 4 weeks. So again, we're talking 45%, 78%, 70%. Now, as this rally got more mature, we didn't gain as much, but still we had nice pre-earnings runs. On October 21st, we reported. So if you go back to this low here on 9/24, we were at 351.30. And if you go from there to the 10/21 close of 422, that was about a 20% rise, pre-earnings run up. And then the last one we reported on January 27th. And on December 22nd, we were at 614.23. we went up 25%. This was in 5 weeks. So 25% in 5 weeks, 20% in 4 weeks, 70% in 4 weeks, 78% in 4 weeks, and 45% in 4 weeks. Now, maybe this is going to be different. We are trending lower. All these others, for the most part, we were moving higher. So maybe you can argue that, well, actually, this one we weren't. Back during the pandemic, we actually had a very similar looking chart to what we're seeing right now. And yet we made this run. So one of the things that I would really watch for is that break above the 20-day moving average. We're not going to have a rally if we can't get through the 20-day. So that would be the signal that I would look for that says, hey, Tesla could be ready to run. And if you get in above the 20, as it breaks above and you end up having to get back out below, you're not going to lose a lot considering how volatile Tesla can be. So that might be one strategy to look at with Tesla, but I do think we're going to get a run with Tesla. And I think earnings are going to be strong. And if they are, look out above, because if we're seeing the economy picking up and we're seeing the stock market go, and we've got a company like Tesla that is beating its earnings estimates by a wide margin. This was a company that lost $5 a share 2 years ago. Last 4 quarters, they actually earned more than $2. So in the last 2 years, this is a company that has completely turned around its bottom line. So if they come out with strong earnings this year and the market moves higher like I expect it will, I think Tesla will regain its leadership position. All right, S&P 500. Let's take a look at what's going on here, because we did come down, put in this double bottom right at just above 3,700, actually triple bottom if we go over here. So I think 3,700 is a pretty big level to the downside. I mean, we're up at 3,940. I don't believe we're going back down to 3,700, but we never know for sure what the market's going to do. And if the market did have another drop to the downside, that would be a key area that I would watch on the S&P 500. I think it's going to be more likely that we see the S&P 500 move through 4,000 and break out. And I think this is going to be a pre-earnings run, so that by the time the banks start reporting, and this quarter, we don't have to hold our breath when the banks report. I think the banks are going to have blowout numbers. The difference in the 10-year Treasury yield and the 2-year Treasury yield, that spread has been widening rapidly. That's going to lead to, in my opinion, some blowout earnings reports from the banks. Now, a lot of it's already been priced in or is being priced in. So it might be a buy on rumor, sell on news kind of a deal. But I think you're going to see the S&P 500 rallying as we head toward these bank earnings. All right, one other chart I want to show you, and this is the specialty retail group. Now, specialty retail was up near 2,500 back in September. Right now, we're at 2,600. So this is a group that has not performed very well relative to the S&P. You can see September, October, we had been trending higher, and we took a tumble for about, 4 weeks or so. And then since then, it's just been kind of flat. So from here through, up to the 2,600 level that we closed at on Monday, we've done about what the S&P 500 has done. Now, we are starting to show relative strength, and we're trying to make this breakout. So I think this is going to be important to get this breakout. The closing high, 2628.90. Just keep that number in mind, because we're less than 1% away, closing at 2608 and change on Monday. And if we get that breakout with relative strength starting to gain ground, that could be a sign that some of these specialty retailers are ready to go. So let's move on. With that in mind, let's move on to break it down. So in break it down, I want to break down the specialty retail groups. Usually when I do break it down, I break down a sector into industry groups, then into stocks. I'm just going to start with the specialty retail group, because if we get a breakout, I think you want to be prepared with some of the leaders in the space. Now, there are a couple of ways that we can do this at Earnings Beats with the tools and research platform that we have. The first thing that I would mention that we could do is we could pull up the strong earnings chart list. We have 2 of those, but if we just do them one at a time, we could then view it. We can view it in summary form. And then we could go in here and we could type in the search box, specialty retailers. And you can see in this particular chart list, there are 5 of them. And in scooter order, here they are. Now, if I wanted to go into strong earnings number 2, I'd have to type this back in again, but specialty retailers, and you'll see 6 more. So in our strong earnings chart list, our 2 strong earnings chart lists, there are 11 of them. And Williams-Sonoma is by far the best one right now, and this is the leader. If you could buy this one on a pullback at some point, that would probably be best. It's made a huge run with earnings. I don't know when or if it's going to come back down, but if it does, I think if it gets back into the low 160s, that is going to be a very attractive area, because that's where we gapped up, and that's where we saw a lot of volume coming in, a lot of buyers right around this 160, maybe even into the 150s a bit. I would not expect to fill this gap back to 137. Not after a gap up with this kind of volume and then continuing movement. I look at the top of gap support. In this kind of a scenario for support, I would not be waiting for $137. I don't think you're going to see it. All right, so that's the other side of this, is that we've got, the 2 earnings chart list. I could then, pull up our strong future earnings. So these are companies that have very strong scooter scores, and they're also not included on the strong earnings reports. So if they've got a strong scooter, but they're already on the strong earnings reports, then I delete them off of this report. So these are only going to be stocks that are not on strong earnings. Now I can do the same thing, type in specialty retailers, and you're going to get a whole different list than what we just looked at. Okay, so here and there you got them in scooter order. The lowest is 83. We got GameStop. GameStop's going to be reporting earnings, I think, Tuesday or Wednesday. So that's going to be, I think it's Tuesday. Might be Tuesday after the close. So you'll want to check that out. That's going to be a very interesting earnings report, not to mention the reaction to it, given what's taken place there over the past few months. Okay, so this is one way we can do it. Based on our research, we can come through here in the search box and we can pull out of our strong earnings chart list companies that are in this group. So, and by doing that, using the strong earnings chart list, we know that these are companies that have beaten estimates, both revenue and earnings per share. That's how they get on the strong earnings chart list. Now, if they're on this chart list, then we know they have strong relative strength, but we don't know necessarily that they've beaten earnings. All right. That's one way we can go about this. Now I'm going to show you a different way that you can go about this, and that is by going to your dashboard and going down to scans. So let's do a new scan, and let's get rid of that the filter that was in there, because what I want to do is I'm going to put up our chart list rather than go through into our chart list individually. What we can do is we can just add the chart list into a scan. So strong earnings 1, strong earnings 2, strong future earnings, and then we could even throw in here raised guidance. And then over under sectors and industries, we go under consumer discretionary or cyclicals, and we can find our specialty retailers and add. Now, if we look for stocks that are in all of these groups, it's going to come back with 0, because I just told you there will be no stocks in our strong future earnings that are also on our strong earnings and strong earnings number 1 and number 2. So if we have and in all of these clauses, we're going to get a return that comes back 0. So what we need to do is we need to put another bracket in here between all of our chart lists. So our 4 chart lists, we need brackets. See how I put the double brackets around these? And then I want to change this to or. So I wanted any stock that is in any of these chart lists. So you got to make sure it says or rather than and. So if it's in the strong earnings chart list, or the second strong earnings chart list, or the strong future earnings chart list, or raised guidance, if it's in any of these 4 and it's also in specialty retailers, then it should come up on this list. Now, the other thing you might consider doing is just saying, listen, I only want it if the scooter is above 75. Okay. So now I've got, if it's in any of these chart lists and it's in specialty retail and the scooter is greater than 75, and then we can run this. First, we'll check syntax just to make sure everything's good. Scan syntax is correct. We run the scan, and here's 16. So this is a different way to get to many of the same stocks that we just looked at. And then you can sort it by scooter. You can put it into a new chart list, store in a new chart list if you want. You can put it in an existing chart list, however you have it set up in your account. But that's how you can go from looking at a group that is on the verge of breaking out and saying, okay, give me the stocks in the strong earnings chart list that are in this group. And so I can quickly zero in on the types of companies that I want to trade. Just being a fundamental person at heart, I was a practicing CPA for 20 years and audited companies. And as a result of that, I still like companies that under promise and over deliver. And that's what the two strong earnings chart lists represent, companies that beat expectations. So anyway, that's how I would break down the specialty retail group and go in, start taking a look at charts and decide, okay, this one I like, this one I don't. So we looked at Williams-Sonoma, maybe one last one. Let's take a look at Kirkland's. And you can see Kirkland's moving up, but mostly sideways here for the last couple of months, trying to make a breakout. But this is a stock that has been trading pretty strong. And if you look on a relative basis, this would be another piece of the puzzle that I would certainly look for. Kirkland's relative to the specialty retail group has been rising throughout the past year. Relative to the S&P, the same thing, rising throughout the year. So if the group starts to show strength and starts to break out on a relative basis, you want to stick with the leaders, in my opinion. So you've got to be looking at stocks like Kirkland's or stocks like Williams-Sonoma. Not so much GameStop. I think GameStop still is one I'd be really careful with. I'm not sure what's going on there. It's made a huge move. We'll see what happens with earnings, and we'll find out whether it's justified. But that one has just been a little scary for me. It's just been too volatile. But then you can see, based on the scooter, you might go down this list and take a look. Big Five Sporting Goods, At Home, Michaels, the Container Store, Bed Bath & Beyond, and so forth. All right. Let's move on. I want to talk a little bit about earnings. So in the earnings spotlight today, I just want to go through a couple of companies that will be reporting later this week. So on Tuesday, we have Adobe reporting after the market closes. This is obviously one of the largest software companies, and software is part of that growth area. So this will be a kind of an early look into a large software company. Now, that's the good news is that this is a pretty solid long-term company in software. The bad news is this company has been downtrending versus software for the last 6 or 7 months. So this is not one of the leaders right now. That tells me this earnings report could be a little suspect. And if it is, that could hurt software in the near term. I would much rather have one of the stronger software companies reporting to maybe lift the group. I don't know. We'll have to see what Adobe comes up with. But if Adobe can beat as one of the weaker stocks in the group, that could bode well for the group further down the road. But let's be a little careful with this one, realizing that Wall Street's not really impressed as we head into this earnings report. Another company that will be reporting on Tuesday, this one's in the morning, so they probably will have already reported by the time you get this recording. But this is IHS Markit Limited, or INFO. I see a nice rally and then a cup. And usually when you see consolidation like this, you see relative weakness. And as I go down here, well, there was your relative high. And we've started to strengthen, but we're still well off that earlier high that we saw. So we're going to need a good report here to get this breakout and a trade back over 100 on IHS Market. As I mentioned, GME is reporting Tuesday after the bell. So, just look at the craziness. This was the short selling, the Reddit folks, Wall Street bets sending the stock up. Then we had the big sell off from 500 back down to 40. Then we went back up to 350. Now we're back down under 200. Honestly, I don't know what to expect here. You can look at it and say, well, yeah, but volume trends are strong. Well, anytime you get a panic situation, you're going to have heavy volume, and that's what occurred with the short squeeze. So I'm just not sure what to do with this stock. It's in an extremely wide range. I just don't know what's going to happen here, honestly. So I personally, for me, it's just to stay away. I have no interest. One other company reporting on, actually a couple more reporting on Tuesday after the bell. First is At Home Group. This is one that looks really strong. I just mentioned this one, or it came up in that specialty retail analysis. But look at home relative to specialty retailers. Very, very nice breakout on a relative basis. This is one of the stronger plays. And then what'll be kind of interesting is our first airline, AAR Corp. AIR is the ticker. AD line's been pretty strong. This one actually has not been a bad performer. It just hit a 52-week high relative. Well, they've got an aerospace 52-week high versus the aerospace group. I think this is going to be kind of a telltale or early sign of what we can expect both in aerospace and in airlines as we go forward throughout this earnings season in those areas. So this, because this is a leader, I think we're going to want to pay attention. All right, let's do two more. So for Wednesday in the morning, we have General Mills coming out. And General Mills has been starting to move higher. I think it's a much more conservative play. AD line, as you can see here, just kind of been going sideways for a while. Relative strength, not very good in General Mills, starting to turn up a little bit. I don't know. I think this run up into before earnings for me is probably a sell signal. I would not be holding into earnings. And then one other one I'll bring up is Winnebago. They report on Wednesday before the morning opens along with General Mills. And Winnebago just recently broke out above this prior high that was established back in June. AD line's been strengthening. Relative strength has been moving up for the past 5 months. This one in the recreational products area, I think, looks much more interesting. All right, let's wrap this thing up with the three you must see. I got 3 stocks here. One, Adient. This is an auto parts company. Just made a big breakout with heavy volume gapping up. Notice over the last 5 or 6 days, we've worked our way back down to gap support and the 20-day. I think maybe it goes to the 50-day, but I think this 37.5 to 40 area represents pretty good support. We were up near $48, $49 just a little over a week ago. So ADNT is a stock that I think we could see a reversal on. MGNX. This is Macrogenics. This is a biotech stock, but I just wanted to point out volume picked up a little bit on it, and it closed over 32.5 and took out all the prior highs for the last year. So we had a breakout. Don't know much about this company, but might be worth taking a look at technically. I like that breakout. And then the last stock I wanted to show you was another breakout. This is in medical equipment area. This is SI Bone. Look at the AD line breaking out. Just took out the sideways consolidation, volume picking up, relative strength to a new 52-week high. All right, that's it for me. Everybody have a great day. Enjoy your Tuesday. Be back on Wednesday over at Earnings Beats for your next Trading Places Live at 9 a.m. Again, that's on Wednesday. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.